Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site, we have Brian Joyce. He's the Managing Director on Nasdaq's Market Intelligence Desk with our midday update. And Brian, it seems to be that growth continues to outperform value. And you would think with all of the outliers that's out there now, that wouldn't be the case, but it just, these large cap names just continue to roll on.
Yeah, it's, growth is what investors are looking for, and if it's expensive, they're still actually, apparently I should say, willing to buy it.
All right, let's take a look at our first chart here. We can get a better indication when we look at this price action between growth and value.
Yeah, so we saw at the beginning of the year that and let's take it back to September and August when value had a 1 month there where it had its best outperformance over growth, and there was a lot of calls that there was going to be a big trend and that value was going to be outperforming growth on a prolonged basis. And we had questioned that all along because we didn't see the technicals for it. And sure enough, growth maintained its perch. And here again in January, we see that growth had a breakout above those mid-year highs versus value. So this is a relative strength chart of growth over value, which means growth is outperforming when the line is trending higher. So you can see right now it's almost like a parabolic wall.
All right, let's take a look at our next chart here, Nasdaq-100, the weekly on that. And of course, that's going to mirror it because a lot of those growth names, those momentum names, are Nasdaq-100 components.
Exactly. So this is the 100 largest non-financial companies on the Nasdaq exchange. And as you can see, it's similar to that last chart where it's just going straight higher, being driven by the mega caps.
Yeah, I mean, think about it. We have Apple, Amazon, Alphabet, Microsoft, 4 companies in Nasdaq-100 with trillion-dollar market caps.
Yeah, it's truly phenomenal. And it's noteworthy that the fact that it's also worth noting to point out that the breadth these days, particularly these last few weeks, has not been as good as we've been seeing in December and January. So that's just something to take note of. And there's other measures that I guess we'll talk about that will are potential warning signs that nothing of egregious to be concerned about, but maybe that suggests a pullback may be coming soon.
All right, and that's what I want to take a look at. Let's look at the 10-year yield because this is telling a little bit different of a story than what the equity markets are suggesting.
Yeah, so we bottomed back in the summer in August and September, and we quickly got up to the 190, 195 level, and you could see it acted as a pretty solid resistance. I was expecting at the time for an upside breakout to take place, and then maybe the real test would be around the 200-day moving average. It never got there, and it rolled over, particularly in late January, around January 23rd. What was the cause for that? Why are investors rolling into the safe haven? It seemed to be come in timely with the concerns over the coronavirus out of China, which is all over the headlines these days, but also maybe potentially what's going on in the Democratic primaries, where Bernie Sanders has now taken I would say, a pretty healthy lead over the rest of the candidates, and he's a progressive candidate. He has approximately $30 trillion in tax and spending policy proposals. So I think the market may be beginning to price it in, at least the bond market.
All right, let's take a look at the 3-month spread. It's also an indicator that you're watching.
Yeah, so here's the yield curve. This is the 10-year to 3-month spread. It did dip negative in late January as we had a few days of risk off that took place in the equity market. And so this is definitely something that's concerning to say at least the banks and the financials, which a lot of investors will look to as a barometer for health of the economy. And so, the curve, as it was steepening in the fourth quarter, we then saw accordingly the financials do well, a lot of other cyclicals doing well, and we're not actually now seeing that. The curve is beginning to flatten. Financials are only up 1% year to date. They're underperforming, let's say, the technology and the broader averages. The S&P is up 4.5%, 5%. The Nasdaq-100 is up about 10, 11%. Materials and industrials as well are also underperforming along with financials.
All right, and our last chart of the day, 10-year again, but looking at the break-even.
Yeah, so this is the break-even. As you can see, it's testing this week the 200-day moving average. We could see in the past the 200-day has acted as a resistance line. The break-evens did get above it in December, January when the peak of risk on, or let's say over the last quarter or two, was underway, but it stalled at that 181 level, which is where it peaked in the summer back in July. So there's different levels of resistance it's running into. It'd be interesting to see what it does here now that it's up against the 200-day. The market is looking for at least one rate cut in 2020, and I think if this does begin to roll over, maybe that would be a sign that a rate cut is more and more likely.
Another rate cut, fresh liquidity into the system.
Yeah,
Nasdaq 10,000 shortly. All right, Brian, as always, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.